Have you ever heard someone say, this option has a delta of 70, or I'm delta neutral, and wondered what they're all talking about? If you're trading options, understanding delta is absolutely essential. In fact, many professionals consider it the most important of all the option Greeks. Today, I'm going to explain what delta is and how it works and why it changes and how you can use it to make smarter trading decisions. Hey, it's Frank Nagy and welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. So what is delta? Delta measures how much an option price is expected to change for every dollar move in the underlying stock or index. Think of delta as your option's sensitivity to price movement. Now here's a sample example. Suppose a call option has a delta of 0.60. If the stock rises by $1, the option increases by approximately 60 cents. If the stock falls by $1, the option should lose approximately 60 cents. Notice I said approximately. That's because delta itself changes as the stock moves, which we'll discuss shortly. Call options always have a positive delta. Their delta ranges between 0 to +1. Now let's look at 3 examples. An out-of-the-money call might have a delta of 0.20, which is underneath the strike price. That means the option behaves like owning about 20 shares of the stock. An at-the-money call may have a delta near 0.50, and a deep in-the-money call, which is past the strike price, could have a delta of approximately 0.90 or even higher. As the option moves deeper in the money, delta approaches 1, meaning it behaves almost like owning the stock itself. Put options work a little differently. Put deltas are negative. They range from 0 to -1. Why negative? Because put options gain value when the underlying asset falls. For example, a put with a delta of -0.70 will gain approximately 70 cents if the stock drops by $1. If the stock rises by $1, the put will lose value of approximately 70 cents. The negative sign simply reflects the opposite relationship between the puts and the underlying asset. And here's something many beginners don't realize. Delta is also commonly used as a rough estimate of the probability that an option will finish in the money at expiration. For example, a delta of 0.30 suggests roughly that a 30% probability of expiring in the money. A delta of 0.70 suggests about 70% probability. This is only an approximation and not a guarantee. Markets constantly change, probabilities change as well. One of the biggest mistakes beginners make is assuming delta stays fixed, and it doesn't. As the stock moves, delta changes. When a call moves further into the money, its delta increases. When it moves further out of the money, its delta decreases. The speed at which the delta changes is measured by another Greek called gamma, which we'll cover in another video. Understanding this relationship helps traders predict how their positions may behave during large market moves. This is one of many strategies DataBridge Capital Management applies when managing non-directional investment portfolios with a focus on risk management and market analysis. The firm's objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth. Professional traders often use delta to estimate their portfolio exposure. So imagine you own 10 call contracts with a delta of 0.50. Each option controls 100 shares, so your position behaves approximately like owning 10 contracts times 100 shares times 0.50. That's roughly about 500 shares of stock. This concept is called delta exposure, and it's one reason institutional traders monitor delta continuously. Rather than simply counting contracts, they evaluate how much risk they are actually carrying. Delta is just about predicting profits. It's about managing risk. If you're bullish, you may want positive delta. If you're bearish, you want negative delta. And if you're trading market neutral strategies like those of DataBridge Capital Management, then you'll be using these strategies with double diagonals or iron condors. You'll often try to keep your portfolio close to delta neutral, reducing directional exposure while allowing other Greeks such as theta and vega to generate returns. Professional traders rarely rely on one Greek alone. Instead, they look at how delta works together with theta, vega, and gamma to understand the complete risk profile of a trade. Hey, to learn more about Theta Bridge Capital Management and our investment strategies, risk management approach, and portfolio construction process, click on the links below in the description box.